Ho ho ho! Now it's time for something spooky. Most people think of Christmas as a time for elves and reindeer, but the Victorians, the people who actually invented the Christmas we know today, knew better. To them, Christmas was the season for ghost stories. And in the spirit of a good, spooky Advent, I want to tell you a ghost story today. It's not about a haunted house, it's about my haunted portfolio. This is the story of a mathematical entity that can create money out of thin air, or rather volatility. It's known as Shannon's Demon. And today, we're going to learn how to exorcise it to get excess returns for our portfolios. But first, the lawyer's incantation. Nothing I say here is financial advice. At the end of the day, I am a guy on YouTube. I am not your fiduciary. I don't know your situation. This is for education and entertainment only. Again, I don't know your situation. I don't know how much you need to spend on pets. I don't know how much you owe to your ex-wife. I don't know. So do your own research before summoning any demons into your brokerage account. So, our protagonist today is Claude Shannon. See, doesn't he look like a guy straight out of a Lovecraft novel? I mean, he kind of looks like H.P. Lovecraft, so it fits. But he's the father of information theory, which is its own kind of cosmic horror. And he's also one of the greatest investors who ever lived. He achieved 28% annual returns from the late 1950s through 1986. And by the way, that was 1% above Warren Buffett. So this guy is in a league slightly above Buffett. Just keep that in mind. Shannon discovered a mathematical anomaly, and it's detailed in William Poundstone's book, Fortune's Formula. It's a way to profit from assets that, on paper, should make you absolutely nothing. And here's the mathematics behind it. So, now for the spell. Imagine a stock that is wild. You probably don't have to think too hard. We live in exciting times. You go from $100 to $200 in year one. You double your money. In year two, it drops 50%. So you're back down to where you started. If you held this stock long term, your return is zero. It's a zombie asset. It screams, it thrashes, but hopefully it's a slow zombie and it ultimately goes nowhere. And in any case, it's not truly alive. It's just going up and down, up and down, up and down, and that's useless for building wealth. But Shannon realized if you introduce a boring asset alongside that zombie asset, like cash, and perform a ritual called rebalancing, something supernatural happens. Well, at least mathematical. If you run a 50-50 portfolio between that wild stock and cash, it'll go like this. When the stock doubles, you'll automatically sell the winner to get back to 50%. When the stock crashes, you use the cash to buy the loser. And by religiously rebalancing, you mechanically harvest that volatility. And this theoretical model that Shannon used as an example, you generate about a 6% annual return from those two assets that have zero expected growth when considered independently from one another. You are effectively stealing energy from the market's chaos. You are converting volatility itself into returns. All right, now I want to show you a quick example of Shannon's Demon in action. So what I've got here is just broad index fund representations of global equity. Not global momentum, just a straightforward Bogle style broad index funds. You've got the global market over here on the right, VT. You've got the total US stock market and total international stock market in the middle. And this bifurcation approach is what a lot of target date funds do instead of just holding VT inside of them. So if you've got a target date fund through your employer, then you go ahead and take a look at the holdings. More likely than not, it's going to split out the U.S. stocks and the international stocks at a minimum. It might even split out cap sizes, and it might even split out emerging markets from international. And the reason that it does that is because of Shannon's demon. Because right here on the far left, we've got the whole global equity universe split out, uh, you know, with all of its cross sections. You've got international developed, separated from emerging, separated from US large cap, separated from mid cap, separated from small cap. So when you do that and you rebalance on, say, a quarterly basis or another regular schedule, you're going to harvest some of the volatility. Those funds are going to wiggle back and forth, and you're going to sell high and buy low overall. And so you can see when we look at the returns of splitting things up like this over 26 years, the global equity cross section that splits it up the most actually gets $12,000 more than global equity in general. You can see how the base compound annual growth rate is broken out here. You definitely get a premium in it with your global equity cross section approach, and money weighted return, you can see, also shows that nice little premium that you get. Not only do you harvest extra returns from volatility, but by splitting up a market into its subsections in approximate proportion to the representation of those subsections in the whole, you also slightly reduce volatility. So you're actually converting volatility itself into returns by taking this strategy, by utilizing Shannon's demon. And you can see, it also improves your Sharpe and Sortino ratio. And it may not seem like much, but once you get into larger and larger amounts in your 401k and your retirement, it's going to make a huge difference. And again, that's why if you look inside your target date funds that you get through your employer, they split things out instead of just taking a broad whole world equity market ETF like VT. So some people like VT and chill. I really don't, because it can pay to be more granular. Now, this is part of the engine inside the Miller Momentum portfolio because it's designed around momentum and trend following. Volatility fluctuation is a trend. Market chaos is something to capture. It is an asset that can generate returns. Well, how do you get it? You invite volatility in, and then you slay it and turn it into returns. This is how. You hold momentum stocks, because they have a little bit more volatility than their plain vanilla index cousins, and you pair them with other more volatile asset classes like managed futures that move in an entirely different direction. So to truly exorcise Shannon's demon and get that rebalancing bonus from slaying volatility and turning it into return, you need an asset that doesn't just move differently, but moves in a completely different dimension. And that's why we've got all of these asset classes together that move orthogonally to one another. So you're always going to be, in the aggregate, selling high and buying low, and reducing your volatility at the same time. I know it sounds like it's breaking the rules of finance, and um, Bogle might be spooked by this, but this is solid mathematics from information theory. It works. Bogle, Buffett, Munger, they did a lot of great work, and you can think of them as, the masters of classical mechanics if you want to take an example from physics. What we're talking about right here with Shannon is quantum mechanics. And you're going to get into situations where things that I talk about are going to sound like they contradict the advice and statements from Bogle. It doesn't, but it's paradoxical. What Bogle says is completely true. What Shannon says here and what information theory tells us is also completely true. But we're talking about different worlds, different universes, different approaches to investment. So keep that in mind. So, with that all said, there is a secret weapon that can even further enhance the Miller Momentum Fund if you have a tax advantaged account situation and if your brokerage offers a catastrophe bond fund that doesn't eat your lunch in fees, because you've got to keep fees and taxes in consideration here. But if you're in a position to do this, it's something to consider and consult a fiduciary about and look into. Um, you can add catastrophe bonds. The Victory Pioneer Fund is the one that I do. It's CBYYX. Now, these bonds pay high yields, currently over 9%, based on insurance premiums. They don't care about the Fed, they don't care about tech earnings, they only care about hurricanes and earthquakes. So that's why this is kind of the perfect holy water for our exorcism of Shannon's demon, to get that volatility out and turn it into excess returns. A market crash won't trigger an earthquake. So this means catastrophe bonds are a high yielding asset that holds steady when stocks panic, giving dry powder to buy the dip. And I've included the CAT bond total return index up there on the right. You can see it in the dark blue line. And it was beating the total global stock market equities for nearly 20 years. CAT bonds historically return comparable returns to stocks, but they are purely orthogonal to the markets, to all traditional financial marketplaces, because you are essentially carving out a little bit of your portfolio to be an insurance salesman and give people set a lump principal up and say, I will sell you disaster insurance, pay me monthly premiums, and if a disaster comes, then you get a share of the pot that everybody's paying into here. So it's highly lucrative in the world of bonds. And CBYYX, I consider to be a very well diversified global catastrophe bond fund. But every ritual has a price. And like I said, because catastrophe bonds are beasts when it comes to returns, you probably don't want this in a taxable brokerage. You're going to want it in tax advantaged and ideally in a Roth account, I think. That's the way I approach it. But every ritual, again, has a price, and you need to know two things before considering this move. First, the fees. This fund has an expense ratio, CBYYX that is, of about 1.46%. That would probably make Bogle give up the ghost. It's high, but remember, this is an entirely different world than equities. This expense ratio is paying for a team of meteorologists and actuaries that actually assess and determine the insurance premiums that countries and corporations are paying on these catastrophe bonds. It is the cost of doing business for uncorrelated returns to stocks and bonds in general, because catastrophe bonds stand on their own. Second, you need to check on access. Funds like CBYYX are institutional funds. You need to check your brokerage to see if you can get it fee free. No front loads, no back loads, no transaction fees. Don't do that, because if you go in for that, again, this is not financial advice. This is just me giving my perspective on it. It'll probably eat away any benefit that you could get from volatility harvesting from Shannon's Demon, because again, it's a slight edge that you can get with this volatility harvesting approach. So I use Schwab One Source to get CBYYX for free. In other words, fee free. I mean, there's still the expense ratio, but there's no load charges or anything like that. So you need to be careful here. Alright, so let's look at what Shannon's Demon can do for us with the Miller Momentum approach. Right now I'm just going to compare the base Miller Momentum balanced strategy to a variant that includes Catastrophe Bonds. And I've picked a Catastrophe Bond fund that has a little bit of history so that we can see how this plays out over the past decade. So taking a look, we can see that the base Miller Momentum balanced approach, it's doing great, especially relative to a 60/40 portfolio. In fact, we can bring up a 60/40 portfolio just to compare right there. Make sure we're balancing quarterly so everybody's on the same schedule. So you can see Miller Momentum Balanced is already killing it compared to the traditional 60/40 portfolio. But when we add CAT bonds by taking down the allocation to the Chaos ETF and the allocation to managed futures and putting 10% into CAT bonds, we get a slight but pretty nice little premium here. It bumps it up from, a money weighted return of 13.24% to 13.37%. And, at not that big of a cost of volatility. Again, we are getting a tiny bit more, not that bad of a cost to max drawdown. Again, we're getting a tiny bit more of a max drawdown from the catastrophe bonds. But at the same time, using Shannon's Demon, we're turning some of the volatility back into returns. So you can see that the volatility here has lowered slightly from the introduction of these catastrophe bonds. It's not much for this strategy, and I really encourage anyone considering this to look into fee schedules and all of that good stuff, because catastrophe bonds, like all bonds, are pretty income intensive, and so they're not going to be that good of a fit for non-tax efficient accounts. So I I only use catastrophe bonds inside of my Roth accounts, um, because otherwise you're gonna get hit with taxes, and it's gonna eliminate the benefit here. But in a tax advantaged account, cat bonds are worth considering. The benefit is small, but it's not negligible. So, rebalancing, especially if you're focused on a strategy that uh, exercises Shannon's Demon, is a source of returns from market chaos. It's not only about managing your risk. You will actually, if you play the game strategically, increase your returns with a regular rebalancing schedule. And this discovery that Claude Shannon made is just proof that you can survive and thrive in chaos. So, this Advent, I'd encourage you not to fear volatility, exercise it, turn it into returns. I'd love to know what you think. And, this is, it is a high fee on this cat bond. So, do you think it's worth the diversification? Leave a comment below and like and subscribe to Miller Momentum. Happy Advent, y'all.